Hello and good night. Wanted to make a quick video talking about how your robo advisor is no different than an Instagram influencer. They do things to actually put products in your face, and with those suggestive ads and articles, might actually drive you to actually buy a certain stock. Also, with the information that they actually gain or gather from you, they actually use that to their advantage and actually sell that data to others. So essentially, you're the product. You're not just a customer or the client. They make money in various ways. So first off, how they make money, is it free? There's an article that I'll be putting in the description box. It'll pretty much get into a couple things. One of the biggest things in that article is trade flow. So what they do is they actually sell trade flow to other brokerages that allow you to actually buy fractional shares. Now that's a good thing for a retail investor because now we can get into Amazon without buying a whole bunch of different shares. That also changes the actual marketplace and is a bit of a paradigm shift in terms of how we actually buy stocks and look at things. We don't have to buy an entire stock that might cost $3,000 to $4,000. We can buy $3, $5, whatever the minimums are, and we can actually get into that stock and take part in some of the gains or the increase in value of that stock. So that's a very nice thing, but that kind of costs you. So for instance, they do these things penny at a time. So for instance, if you buy a stock at $10, that stock probably actually costs $9.99, and then they make money off of that penny. Now that's really good because now you can get in. It's a lower bar of entry. But also the bad thing is that it also may not be the cheapest that you can actually get that stock price for in terms of it being settled. This is something that was actually brought up. A case was brought up against Citadel on this very matter, and I'll try and find an article to back that up. But essentially, what Citadel was, what they were found guilty of, is not finding the cheapest price to actually settle not finding the cheapest stock price. In terms of what they gave their customer on the other end. They found whatever price they wanted to, and they gave that to you, and that was about it. That's some of the things that you see even with Coinbase and how Coinbase deals with their fees. And then, it's another thing. It's something that I'm somewhat used to a little bit in terms of when it comes to silver, because with silver, they always have that premium, and it's not always the best price. And in some cases, it fluctuates so much, or it may fluctuate. And you may actually get some dealers that might charge a different premium, either a $2 or $2.50 premium. Now, that's not what the premium that you're seeing nowadays. Because of the shortage in silver, you're starting to see where the premiums are actually a lot higher, getting up towards the $14, $15 markers from what I've actually been hearing. And I got that information from Silver Report Uncut, a very good YouTube channel. Very, somewhat pessimistic, somewhat doomsday, if you will. But I really like that point of view, because it's more of a reality point of view in some cases, and that level of pessimism or realism in some cases, but that level of pessimism can actually help you be a little bit more of a prudent investor. Also, getting your mind geared towards, okay, what to do when a crisis hits. That's really good for in terms of strengthening your mental during these times. Next, 1 cent at a time. As I said before, they make these things off of they make money off of each trade, and it's usually the higher end, your Robinhood, M1 Finance. They'll get paid for trade flow, meaning they push trades to different brokerage firms. Those brokerage firms pay them for that trade flow. The way the brokerage firms make money is by charging you maybe a penny or more over that price. So to you, it looks like it's free, but in actuality, there's a little bit of a premium put on it. This is the same thing I just got into about silver. So for me, it's not something that was a big deal or an issue, especially if you're a long-term investor and not an actual trader. This is not a big issue, because if you have a stock for 6 months in some cases or longer, that trade value, that actual value of that stock, will be a lot more over time. So therefore, it's minuscule, the charge that you're getting from these higher end or these brokers and clearinghouses, such as Apex, Citadel, and I think there's a couple others, but I don't really know them off the top of my head. Now, What this shows you, though, with what's happened with Robinhood and GME or GameStop, is that a lot of these robo advisors are not well financed or not very liquid. They're not properly backed for big influxes of trade flow or big issues in terms of valuation. Now, that could be a very serious issue, especially for a retail investor who doesn't understand and know all of this. We might say, oh my God, this is crazy. I can't believe they're doing this. They're rigging the markets in terms of what Robinhood did. But then when we actually look at it a little bit closer, if Robinhood doesn't have that level of liquidity, then you're screwed. You really can't sell in and out of anything. And you may actually, I don't think you'll lose shares or anything like that. I don't think it'll get that extreme. But you may be in a very precarious position because you cannot actually trade in and out of something because that platform doesn't have the liquidity to actually front that money so that they can actually fulfill regulatory guidelines. So that's just something that you have to look out for. So even with the GME stuff, I totally understood it from the Robinhood standpoint of it. No, I wouldn't expect a company that's starting out like that to actually have that level of liquidity, which brings to mind what you're seeing with a lot of different trading platforms. A lot of different trading platforms, a lot of the older trading platforms that didn't have free account or sometimes don't have free accounts, or don't have a free trading or investment service. Maybe even Charles Schwab, which I believe they actually do have a free service, but they also have a paid service in terms of brokerages. So what they do is they actually charge a premium, and they're upfront about that premium. I'm not sure what the price is on that premium. I've never been in any of those. Now, with that being said, they actually have greater liquidity simply because they're actually all that money that they're making from, instead of not trade flows but from actual trades, they can actually front run these things a little bit longer. So people that were in some of these higher end brokers or brokerage accounts where they have a little bit more money in the bank in a sense, and they have better liquidity, they were still able to trade in and out of GME. And that's where you saw most of that trade flow and volume, that trade volume come from, is higher level investors, well-capitalized investors and well-capitalized brokerage firms. They were the ones that were moving that stock more than anything, along with people that were holding. After a while, the retail sentiment only accounts for so much, so it's not really that big of a deal. But what you're seeing, though, or what you saw, is that stock was still going up and doing very well. And then, of course, the eventual sell-off that everybody witnessed to where GME is down to where it is now. I believe the last time I saw it was at $92 a share, coming from a high of about 500. Now, this goes back into my previous video where I talked about taking money off the table. Also, that interview that I did recently with Lionel of On Crypto with Lionel, and where we talked about, hey, you've won. Take some off the table. Go ahead and take that money and put it into another stock or a dividend producing stock where you don't have to sell it, but then you can get the actual benefits of keeping that stock. So we talked about what I like to call a crypto flip. So for instance, the gentleman with, I think it's Roaring Kitty, he lost about $13 million supposedly with GameStop. If you take that $13 million at the current market price of AT&T, it was probably about $29.80 something cents or something like that last time I checked, or maybe $28.93. I think that was the price. And when you look at something like that, if you take that, put that into shares of AT&T, it should yield you a dividend of over $400,000 per quarter. Take half of that, reinvest the dividends, or take half of your dividends, reinvest it, so it can actually be a perpetual machine or a perpetual earning machine for you. And then from there, actually go ahead and, you could take the other half for your living expenses, buy a new house on the Swiss Alps or something like that. I don't know, buy a damn castle. I mean, that's what that money could do for you. That's with a dividend rate or a dividend payout of 52 cents, I believe, as of last quarter for AT&T. Now, AT&T is not a stock that actually rises in value very much. It's fairly steady. It's traded sideways. I'm usually in the red on it, but I don't care because with the 30 shares that I have, I get $15 every quarter. I'll take it. So taking out that money when necessary and just knowing hey, listen, you've won. let's just go ahead and cover ourselves and make sure that money always works for us into the future. Next, how do robo advisors make money? So one is ads. Whether you know it or not, and what's actually been revealed is that a lot of the articles that you see on a regular basis on some of these under your stocks, I'll see things from I think it's Zing or something like that. Definitely Seeking Alpha, CNBC all the time. But they'll have articles, Motley Fool. They'll have articles saying, top 5 stocks to keep for dividends, top 5 stocks to do this, why NetApp is the stock to buy, why Cloudera is this stock or that stock. And it can actually be bad too. Well, what they do is they actually sell spaces in the sense what articles should show up. It's not something that's organic. Hey, listen, they wrote an article and their crawlers have found it, and now next you know we have the best article for that stock of the day. In some cases, some of those articles are somewhat ads. Now, what happens is you actually that generates flow to that website, and then that website, of course, makes money off the ads on that page. So that's how they make their money back, by making the investment or making the initial investment of paying to have their articles show up and not really be seen as ads so much to you and I, but they do sway our decision. And that's why I say some things like, hey, or that's why I started with the premise that these robo-advisors in some cases are no different than your Instagram influencer or anything like that. So be careful of that. They are swaying the way you think. Do other types of research. Like I say, you have to take these things with a grain of salt. Last, one of the other ways they make money is financial services and loans. So for instance, I use M1 Finance. I talked about it in my YOLO move, and with M1 Finance, I have about a $6,000 credit limit, and that's 35% of my non-taxable investment portfolio, or my non-retirement investment portfolio. So I've actually taken down lines of credit on that, or on that portfolio, and then I've put it into cryptocurrencies. I believe cryptocurrencies will do well by the end of the year, and I'll make that money back and cover all the interest that I actually have to pay on that loan. So as long as my portfolio doesn't lose too much in terms of value, or 42% of its value, I should be good to go. So far that has not happened, but we're in a bull market. It can change. So with that being said, I put it into something like cryptocurrencies instead of just actually buying something, because I'm afraid that actually will change. But if I put it in cryptocurrencies, they're highly liquid, and I can actually cover that margin call, because it's essentially a margin account or collateralized loan. I can essentially cover that margin call pretty easily and transfer money right back into the account, so that I don't have to sell any of my securities, ETFs, and things like that, and my stocks. So they provide loan services. Now with M1 Finance, they actually have an M1 Plus that opens up different a second trade window for you throughout the day, so that you can actually trade either morning or night, but you can't trade them both unless you have over, I think, $25,000 in your trading account. Now that's a good thing. I like having that line of credit, but with the M1 Plus account, they actually changed the percentage rate in terms of that loan from 3.5% to 2%, which is really nice. Also with the M1 Plus account, and actually me using the M1 Spend, I make 1% a month on the money or the balance of my checking account. So that's really good. So I can take that extra money and then transfer it along with other monies, so that I can actually put a little bit more into my stock portfolio. So it's kind of one of those, like, every cent counts, and that's a really good thing. Pretty much that's what I have for robo-advisors in terms of my thesis, or my hypothesis here, or my train of thought, in terms of thinking or saying that most of these robo-advisors are no different than your Instagram influencers. Most Instagram influencers, they're there to actually influence you into a certain way, be suggestive, it's called, or it would be considered suggestive marketing. It's marketing that suggests something to you, gives you so much information on actually what decision you should be making, but you think you're making your own decision, when in fact it's actually influenced by other parties or by an outside force. Now, this happens a lot. This happens even in our life. This happens with bigger brothers, sisters, and other people in our families. But this is something where it's somewhat, in a sense, insidious, or it's something that is seen as a bad business practice because it is not actually, it does not have the best interest of the customer or the retail investor in mind. So be careful. Just like I say with myself, if you're not taking what I say, or if you're not looking at what your robo-advisor is actually pushing towards you, or even your own financial advisor that doesn't have a fiduciary responsibility, if you're not looking at these people with a grain, or taking their advice with a grain of salt, then you're low on sodium. This might be one of those things where you want to be a little bit higher on sodium. You want to actually take it and say, hey, listen, I like what you said, but I might get a second opinion, or I'm going to do my own research just to make sure that there are no problems with what you just said. Now, with that being said, thank you very much, and I appreciate you as always. Have a nice night.